I try to keep these videos short for me. This is my journal. I have to be able to watch these videos. If they're all 50 minutes long, I'm not going to watch them. If you do like this content and you want more analysis on the weekends, I'm trying to post longer videos. It's a good spot for me to collect my thoughts, and, well, I should just get going on this video now. I am going to try to include some more instructional things, referencing Volkowski's webpage and trying to share at least one item or piece of technical analysis from there every day. Okay, here we go. So today started with an immediate test of an uptrend that we started on Friday. And this uptrend was the reaction to a big spill down. And actually, if I zoom out, you're going to see how big that spill was. And this happens over a couple of days. Is that one day? That's 2 days. Whew, look at this big dump. One big dump, one day. Yeah, so you can see those three crows, these 3 days, these were aggressive downtrends. And we did have a downtrend established here that was broken today. And I am intersecting the price there a little bit, which technically makes this an internal trend line, not an external trend line. An external trend line does not overlap the price at all between highs and lows. So here's our low, and the high is 3 days ago. So between that point, this is where that downtrend would be drawn if it was external. And you can see when I do that, how all of a sudden, these peaks that we had earlier this morning suddenly start lining up really well. So I originally had it drawn as an internal trend line, cutting out the topping pattern here that we saw on Friday that led to the downtrend, but now I have it all lined up, and you can see that the uptrend we started on Friday is actually now a corrective trend of a 3-day downtrend. This could mean a couple of different things. I'm going to go into that a little bit, but I want to start right now with what I saw in the morning. I entered right away, not right away, but I did wait a couple of minutes because I knew this was going to be a tricky day today. I entered into a May 6th, 1650 strike put for, I think it was $145. And I chose this particular option because its expiration wasn't within the next 2 weeks, because the strike was currently it was the first strike in the money. And the problem is that I would rather have purchased a put that was well in the money, deep in the money, something like an $18 or a $19 put. But I only have so much money, and so I have to compromise. And that was the compromise, was going with just barely in the money. And I want that contract in the money because the longer you hold a contract that's out of the money, the more its value depreciates. You really need that intrinsic value that comes from passing over that strike price and running into the money. So I'm hoping that, giving myself that time, that 3 weeks, that the price will have time to make its move as it breaks out from this giant bear flag. The next next put that I purchased was a May 14th $10 put. And this is more speculative. It is a $10 put. I chose $10 based on the price target for the flag. And I chose May 14th because I need more time to let the price reach that strike. And I don't want the strike to be met. I don't want the price to meet the strike price at expiration. I want at least a week before expiration. That's going to have the best effects for me. And my aggressive and risky playing with fire trading style. Kids, don't try this at home. The next put I bought was an April 29th 1450 put. Okay, and this is based on the $2 drop that I think we're going to see it this week. At least a $2 drop this week. At some point, I think we're going to be further down than that. So I bought these puts mostly due to their expiration dates and price targets. The costs are pretty high for the in the money put, very low for the more speculative put, and a little higher for my weekly target. So I'm going to see how this goes. This is going to be a little interesting. If I can place a good set of trades on Monday morning, and then Tuesday comes around and things shape out correctly, well, whether or not they shape out correctly, it doesn't matter. When I sell those options tomorrow, I'll have the cash to spend immediately. I won't be stuck in clearing. So this basically doubles the amount of money I can spend in a day. If things go my way, that means that I can really get into those gains. If I have to actualize a loss, that's fine. I'll have that cash ready to try to make a recovery. So what happened this morning is we did have a couple of bounces off of that trend line, and there's kind of like this aggressive buy signal line at the end of double and triple bottom. Like when you find these valleys, you can take a downtrend, it's a simple downtrend, connect the highs, and there's an aggressive buy signal, right? And here, Bukowski says this, you can buy here and it's aggressive, but you're likely to win a little bit of money. And here we go, boom, up it went a little bit. On this one, after that third valley test, you can see that there's like this curve here. This is a really strong reversal that I've seen in AMC a lot. If you got a lot of tails and closes and opens all clustered together like that in a rounding fashion, especially right at a level of support and resistance, like you have this uptrend here, this is typically pretty strong. The volume was really low, the RSI was wishy-washy, implied volatility was dropping, so I was unprepared for the boom, the push higher up to that downtrend. The price did initially reject and then come back up. And I was walking away all the time today. Like, as soon as this thing started bouncing between these trend lines, I mean, I was hoping for a breakout, but it's just not. Look at this. This is the classic rectangle. You got two levels, 1694 and 1666. And at one point, these two trends converge, and it looks like that downtrend was going to lose, but no. Look at this, a double bottom forming on that 1666 level. And where's that level coming from? I don't know. Probably the bottom here on the 21st, and there's probably another day back here. Oh yeah. Oh wait, that's higher. No. But yeah, the 1666 level is one I'm now watching very closely. It seems to be the next level to beat before the next big downtrend. And you can just see what happens is that downtrend comes to an end, there's a dip down, and boom, now the price has broken down below the uptrend. It's trying to come back up to it, it's trying to reclaim that strength, trying to regain that bullish momentum, and ultimately it depends on where you draw that trend line, whether or not the price closed above or below it. I don't know. It's tough to say. So the more strictly you draw that trend line, the more conservative the analysis is. So there are some bottoms through here in the morning that I let go as being placed below the trend. As you can see, this is an external trend line that I drew on Friday, and then those bottoms occur on that trend if I don't move it, making the trend line internal. So what I might do is just copy it and pull it down a little bit, and now I have an external trend line, right? The high being the highest high of today, which was somewhere back here near $17. So the lows that formed here are now are below that trend line. And that does not make this an internal trend line because it's actually drawn between these 2 points. So if I were to draw another uptrend based on that, this high and this low would be the same, right? This means that for me to be able to draw an external trend line that drops to here, we're going to have to get a price rise above today's high. And that would be pretty bullish, right? But we're going to leave it here for now. I think this is the best way to look at this. The price is officially in an uptrend. It's a very weak uptrend. It's probably corrective in nature. And what I mean by that is it's a failure to establish bullish momentum when the bears are taking a break. And that can be bearish. I'm going to zoom out into the 15-minute time frame really fast. I can already tell that I'm going to be taking way too much time. Let's go to the 15-minute. Oh yeah, here's where I had drawn some expectations I have. You know, I do that on the weekends and I'll document it. It's really not analysis. That's speculation, but that's what people like to see. So I don't mind speculating a little bit. The analysis has a drop to 898 on it. That's the bear flag. And you can see that I have two parallel trends here. And this is kind of the question that I want to ask today is, what are the trend lines for that flag? Because if they're horizontal, that might not be as good as if they're, you know, sloped downward, but it's hard to say. Nonetheless, that's where I'm at. I'm trying to figure out what the slope of this flag is, because if the flag is pointed downward, that's going to be, or it's going to have some significance in terms of the overall bullish or bearish momentum. So I'm going to go ahead and pull out my channel drawer. I'm going to connect to those peaks, right? And this is the thing. If the flag looks like this, all right, that's a breakout to the upside. But I don't think that is, because it doesn't incorporate any of this price action back here. I think really what I need to do is go out to the 4-hour chart. Okay, here we go. See, that would be a downward channel, but not necessarily the flag. I think the flag starts back here. Let me, I don't know why, but that tool is hard to use after you drop it. So there are two peaks here at a horizontal level, right? But I also have some nice valleys, some dips, a valley here and a valley here I could use too. And this actually looked way better on the daily, because this is clearly moving down, right? Clearly moving down. The question is, what's the trend? So if I take this low and yesterday's low and connect those two, okay? And then pull my flag up and use this high here, and that would correlate with this high as well on the 14th. You can see that there might be a little topping pattern here above that downtrend, and that's okay. That's typically how topping patterns form. It would be above levels of support and resistance. Yeah, that looks like a little funny bump and run reversal, maybe some sort of weird head and shoulder top, doesn't matter. I think that might be the best way to draw the bear flag now. The primary difference being that there hasn't been a breakout, if that's the flag trend. The price hasn't closed below that lower level yet. However, if the price trend, or if the flag is actually horizontal using these two valleys and then using the tops of these two big candles, then there has been a pull back up into the pattern. So either way, it's not looking super bearish, because the pullback does hurt post breakout performance. However, there is still a likelihood that we'll see the price target met. And I say that because volume today was like atrociously low for, yeah, it was just as high as on the other days, right? Not necessarily a breakout or reversal. It is a nice pattern, but I just think it's the AMC swoopies. That's what I'm calling them now, the AMC swoopies. I'll go over that too. You can see that implied volatility made a sharp and distinct turn down. That's all that matters to me. I'm looking for rising implied volatility on red candles. You had it here, and you had it here, these 2 days, or these 3 days. No, this one IV dropped, these two candles. So if the IV reverse correlation here at this reversal, then this is still looking bearish. Still looking bearish. Now, I did say I was going to go into Bulkowski's website, so I'll do that now. And we're just going to look up pullbacks, because pullbacks are annoying. And it's a technical term. So this is what a pullback is. Bulkowski writes that after a downtrend breakout from a chart pattern, price drops, but then sometimes curls upward and returns to the breakout price or chart pattern boundary. Thus, curling price behavior is called a pullback. This page provides detail on the behavior of this unique chart pattern. So here's a pullback. An example he gives. Pullbacks can take any shape. By convention, they occur within 30 days of the breakout. And the stock must not slide along the breakout price, but must drop down, curl upward, and return to or come close to the breakout price or chart pattern trend line. And that's basically what we have. He says high volume breakouts have tendency to pull up more than low ones. That doesn't matter. And then we've got some statistics here. 58% of 8,000 patterns since the year 2000 have pulled back. It's a lot. It's a high likelihood, all right? He says price drops for 6 days after the breakout on average before beginning the return journey. And it's already returned, right? It's already pulling back up, which is making me think that it's possible that it's less of a pullback and just a half-staff tilted flag. And we actually haven't seen the breakout yet. And that would bode poorly for my timing, which is notoriously bad. Or you should know it's notoriously bad if you've been following my my YouTube. So this is probably the slope of that pennant. It's probably down, and it's probably complete, because I remember we were at a 3-week max for this time frame. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19. So, once if the price can maintain this trend for another day, for another 2 days, it leaves the flag analysis and it ceases to be a flag officially, and it'll start be considering a rectangle, which is, not my favorite. Not my favorite. Rectangles are not my friend. Okay, however, this may be a partial rise. So let's go through and talk about what partial rises are. The thing about partial rises is that they occur within channels. I don't think that they necessarily occur within flags, but flags inherently have a channel in them. So let's go partial rise. A partial rise is a looping chart pattern at the that appear at the end of a broadening pattern and rectangles. They predict an imminent downward breakout. So for instance, this is a partial rise, okay? You got a megaphone here, and the price comes up, fails to reach that upward boundary, and then falls downward, right? And he's very specific. Bulkowski would not say that these occur at the ends of flags, right? But I have found that really any partial rise, any failure to rise to a level of support or resistance is a sign of weakness. And it's just more notable in these patterns that have sloping trend lines, right? So I ask, why not a half staff tilted flag? I'm gonna go through and look at the ID guidelines really quick. He says the rectangle or broadening chart pattern should be established. So let's talk about rectangles. When he says rectangle, Bulkowski is really talking about a pattern that's more than 3 weeks long, right? So technically he wouldn't be talking about this. This is kind of a reach. This is a capism saying I've observed this and I could be totally wrong. Could be totally wrong. He says don't look for a partial rise until you have a completed rectangle or broadening chart pattern. And I don't think we have either of those. I wonder if there is some sort of broadening pattern there. I mean, I would doubt it. I would have already seen it, I think. But maybe we do. I'm gonna back out. I'm gonna go 4 hours. Yeah, this is the live real-time analysis. This is what I don't do on the weekends because you never know. This could be nothing. It could be nothing. I'm going to use a price level to draw what would be the top of my broadening formation because I distinctly have 2 peaks there, don't I? And then I'm going to use a yellow line to try and draw. I'm going to start at that. I'm going to start here, actually. I'm going to say that looks good. Does that look good? I think that looks good. I think it looks real good. I think I found a chart pattern. Huh, there it is. Do you see it? I see it. I'm gonna make this yellow and I'll draw my arrows. God, this is gonna be a long one again. There's green. Ugh, why is it green? Make it yellow. Muchísimas gracias. Okay, here we go. So we got a touch there. Oh my goodness, I didn't save it as default. I'm not gonna edit this either. Hurry, quick, click around. Duplicate, so 1 touch, 2 touch, and then I got a 3rd touch here. We've got a 4th touch there. And I've got a 5th touch there, and this might be a partial rise. Ooh, yeah. Ooh, yeah. That looks good, doesn't that look good? You got a tail out here. Let's open up the 15-minute time frame. That gives us more definition. Sometimes it's better to see things in that time frame and then zoom out, see if it fits. Let me pull this down. Oh yeah, can you see that? Isn't that great? That's so great. Such a great view. Now we're getting somewhere. And also, we're not looking at our indicators right now. Now I'm showing something good. Yeah, that is definitely a descending broadening wedge. So identifying the partial rise in the pattern actually helped me identify what pattern it was. Now, it doesn't mean it's not a half-staff tilted flag. You could look at it that way too if you wanted to. And that's the beauty about the analysis is it's generally all the same. Like all these chart patterns are related and they all meet together. Like you know, basically all chart patterns do this. Every single one does that. Whether or not you come down into it and up out of it, that's the difference between a rectangle bottom, right, or a rectangle top. Or maybe you come back down and do this again and break out and up. Now you have a double bottom. You know, it's all just how many squiggly lines you got, and that's your chart pattern. And I don't know why it works, but essentially it's just the study of how the price tends to be bought and sold at certain price levels over time, which is important. That time is important because there's these descending trend lines. This is an implication of time. This is an expression of time. This horizontal level is an expression of price point. So over time, the price is sinking and the price is failing to get above this level. That's pretty bearish. So, you know, I just can't help but think, you know, tomorrow, dump time. Let's just hypothetically say tomorrow, dump time. Boom. That would be a big partial rise and we'd have a big breakout. Now let's go ahead. How long am I at? What am I at? 18 minutes! Whatever. Okay, here we go. So we're gonna go right angled, I think is how this thing starts. Right angled? Right angled and descending broadening formation. I love this website. It's like designed 10 years ago, but it's so good. Okay, here we go. The right angled and descending broadening chart pattern about ties with performance of right angled ascending broadening pattern in bull market, 43% average rise, blah, blah, blah. So let's talk about ID guidelines first. Price trend can be up or down. Shape, a megaphone tilted down. The top line is horizontal. Touches at least 5 total. 3 peaks and 3 valleys should touch the associated trend line with 2 or more touches of the other trend line. Got it. Ideally, the second of 3 touches will touch instead of coming close to the trend line, because, you know, that's okay. Sometimes you don't have to touch the line to make a touch point. Breakout is 64% of the time upward. Well, I mean, that would be a big ask. That'd be a big ask, especially as this thing comes out of a big flagpole. So I'm gonna have to bet on a downward breakout of this one, despite that stat, because it doesn't always do so. You gotta read into these things. Here we go, the measure rule. Compute the height from the horizontal trend line in the measure rule to the right to the lowest valley A, and then multiply it by the percentage mean price target. I can do that. Let's find out what the percentage mean price target is really quick. Percentage mean price target for up and downward breakouts. For down, it's 51%. How tall is our pattern is the next question. And let's just get to it. Pulling out the calculator here. Here we go. Here I go, calculating price targets in my videos live. Well, not live, but I mean, it may as well be at this point. High is 1901. And if you would like seriously, if people want to see me do this live, comment, let me know. I will do that. That's like, I could do that on my lunch, you know, like that'd be kind of fun. For me, that's power hour. So what are we going? 1901 minus the lowest low. Down here. 1610, I knew that. 1610. That's a pretty tall pattern, right? And then we're gonna take, what was it, 51% of that. There we go. And now, where do we apply this to the breakout price? Subtract from the lowest valley. Interesting, it's not actually the breakout price. Usually it's the breakout price, but here he says valley. I'll have to check in his book here what he says. Sometimes it's different, but it's typically all the same. So we're gonna make this a negative number, and we're gonna add it to 1610. 1461, that's the price target for this right angled and descending broadening wedge. What a name. That's just like, it's killing me. So here we go. Right angled descending broadening wedge target. And of course it's bearish. There's gonna be 2 targets, an upward and a lower, but I'm not gonna look at the upward target. I'm not gonna bother with that until we get up there. Just gonna copy and paste this. Pow! And there we go, 1461, that'd be down here, and we're gonna turn on the right extension. Whoops, that was the left extension. Turn that off, right extension on. Okay, there we go. Interesting, now I see something else too. Now I see something else. Do you know what it is? You might know what it is. I know what it is. Here we go, here we go. You ready? Are you ready? I'm gonna zoom in. And I'm gonna pull a retracement. So we know that this peak started three identical crows. There are 3 tall black candles, but they're 3 identical crows. So I'm gonna take that peak, I'm gonna measure down, and I'm gonna see if I don't see a measured move down in here. Ooh, come on, Cap, another measured move down, yeah. So I do this backwards. And that 70% level here, this is the least you can retrace in order to qualify for a measured move down. And well, there you have it. That's a measured move down right there. And this is cool too. Watch this. The first leg of this measured move down has a measured move down in it too. Take let's see here, that low, and here you had a push down, and on that day, the 61.8% retracement level came right here, and you can see another push down. Now, here's the kicker. The measured move down theoretically has a second leg equal in amplitude to the first, and a failure to establish such is considered a sign of weakness, okay? Hinting at reversal. So, you know, the target for this measured move down is way down here at 15, but where to turn around at 16? So that would be a sign of weakness, and sure enough, the price did reverse, and we have another pull up. And what are we looking at now? Well, that first leg down was just a nested measured move down into another measured move down, and maybe we see a rise of that 61.8% level. We don't need to, but we may. Tomorrow's open, and then boom, another plunge downward. And where would that theoretically lead me. I'm going to go ahead and draw that first leg again, copy it, apply it to the top of that, and ooh, sure enough, piercing through that 1461 level, making it in range. Yes. There it is. That's what I'm betting on. I'm betting on that pattern. Another measured move down. I know it's tiring to hear that all the time, but that's just what I see. Really simple 1, 2, 3 corrections inside of 1, 2, 3 corrections, and that's why Elliott wave theory is a thing. That's why fractal theory is a thing. It's just the way that the price tends to move. So I don't argue with results. That's the way I see it. So I'm gonna go ahead and stop talking now. It's been 25 minutes. I need to make dinner. Happy trading.